I believe that we're going to be facing more economic pain over the next 24 months. Now, that's just my opinion. I could be wrong. But the reason why you want to listen to me is because if I am right and you don't prepare now, you are going to be the one paying the price. It costs you nothing to be prepared. It costs you everything if you don't prepare. Let me give you a little flowchart explaining what I mean. If we see no economic pain and you're not prepared for anything, you're okay. Nothing's wrong because you face no economic pain. If you're prepared, you start preparing for a recession, but we have no economic pain, well, now you have some extra cash put aside, and you can take this cash and you can invest it, or you can take this cash and go to Disney World. Again, nothing bad happens to you. If we see economic pain and you are prepared, now not only do you have the ability to survive through a recession, but you're going to have the ability to thrive through an economic recession. If we have economic pain and you're not prepared, well, now, not only are you not going to be able to thrive and be able to capitalize on opportunities that come your way, but you might have a tough time surviving through it. Why is it that looking back, everybody says you should have bought real estate after the 2008 crash? Why do people say you should have bought dot-com companies after the 2000 dot-com crash? Because most people were not prepared. So, if you prepare and nothing bad happens, well, now you can go to Disney World. If you prepare and something bad happens, well, now you can take advantage of opportunities or potentially go to Disney World if everything is okay. I'm not going to go over the why I believe we have economic pain coming in the coming years in this video. I have other videos where I talk about that on my channel, and I'll also link some for you down in the description. But what I want to do today is go over first how you can survive, and then I want to go over how you can thrive through a potential recession. First, let me talk about how you can survive with number one. You got to start by stabilizing your income. If you are a commission salesperson, if you're at a company that's on the verge of going bankrupt, if you work for a company where you don't think your position is secure, if you have a business where the income is very shaky, this is where you got to get a little bit more cognizant about how you can stabilize the income that you have. But think about it. Look at other companies in your industry and see what they're doing. If every one of those companies are laying off your department, well, now you got to look into the health of your department by looking into the health of your company. Now, you don't want to panic because even if you go through a recession, the majority of people will keep their jobs. If you look at the 2008 crash, the Bureau of Labor Statistics reported that Michigan was hit the hardest by the economy, and the highest unemployment rate in Michigan was 8.4% in the 2008 crash. Now, 8.4% employment is the reported number. The real number is probably a little bit higher, but even if you doubled that number, you still have the majority of people, the vast majority of people who have a job, who want a job, who are still employed, who are still getting a paycheck. So what you want to do is just make sure that where you're getting your income from is stable. Now, if you have more of a variable income, you're a commission salesperson, you work for a company where your income goes up and down, this is where you want to be a little bit smarter and understand, one, how much income you can expect over the coming years, and if you're going to be able to continue sustaining your income that you have right now. Look at the mortgage industry. So many mortgage lenders have been getting cut off or just leaving, not because they're being laid off, but because they're not making any more money. They're not able to sell loans. They're not able to refinance mortgages the same way that they could before over the last couple of years. And so you got to take a look at what's going to happen over the next couple of years. If interest rates keep going up, how is that going to affect your industry? How is that going to affect your job? And how is that going to affect your income? It's better to prepare sooner rather than later and think about what you can do to stabilize an income, because the first step to surviving through any sort of economic slowdown is to have an income that will carry you through the economic slowdown. The second step to surviving and thriving through an economic slowdown has to do with another surviving technique, which is now doing some spending control that way you have a savings cushion. You have a pretty decently sized chunk of America who made more money than ever over the last few years in 2020, 2021, and even 2022 through bonus checks, through commissions, and through extra distributions because their company boomed or because they got these big commission checks from whatever it is that they're doing. Well, many of these performance-based incomes are going to see their incomes dwindle in the coming years because these same companies, the same banks, the same lending institutions, the same salespeople are not going to be able to make the same bonuses and get the same profit distributions as they did previous years because many of these companies are now starting to struggle. I work with a lot of realtors. I work with a lot of lenders. I work with a lot of different salespeople. And what you saw happen, especially when it comes to salespeople, I'm going to be completely real here. Many of these people When they make more money, they upgrade their lifestyle. It is a very common trend in the salesperson community that when you start making more money, you get a better car, you get a better home, you go on better vacations, you start living a much more inflated lifestyle because you make more money. The problem is that salesperson commission, the salesperson income is not always stable. You go through booms and you go through busts, just like the economy. And if you go through a bust in the economy, guess what? Your income also goes through a bust. And so you saw many salespeople, I know many people in my own circle, in my own community, that saw their incomes boom over the last few years. And along with that, their lifestyles boomed. Bigger homes, nicer cars, better vacations. You have expenses that have skyrocketed over the last few years. But if your income cannot sustain itself, what are you going to do then? This is where you want to play a little bit of damage control right now, be proactive, and understand how much of your income is really sustainable. And what can you do to downsize a little bit right now to protect yourself against whatever might happen? Are there ways for you to cut out some of your expenses that we can put aside some cash? And even if you don't want to cut out expenses, do you have a cash savings buffer? If not, this is where you got to start. You need to put aside some cash. You want to have at the minimum of 3 months of cash put aside to protect you against an emergency. You can have up to a year depending on your risk tolerance, but you want to have at the very bare minimum 3 months worth of expenses put aside in a savings account, not as an investment money, not as a fun spending money, but as emergency money in case something bad were to happen and you no longer have an income, that you still have 3 months worth of cash that you can spend where you wouldn't have to sell anything. You wouldn't have to change anything, where you can work to create another income over those 3 months to rebuild your income, and you have cash to protect yourself. You have to have at least 3 months worth of cash put aside in an emergency account. That way, if something bad were to happen to your income, you can still protect yourself. Now, if your spending is controlled, then you can take this one step further and you can put cash aside, not just to save, to protect you against an emergency, but to invest. This is cash that you're waiting for a good opportunity to take advantage of, where if you see a distressed asset, you can come in and use your cash to buy it, because what happens anytime you see a bigger economic slowdown is credit dries up. It's harder to access cash. Investors become scared. People don't want to put their money out there. So now if you have cash, you could come in and take advantage of opportunities, which brings me to number 3, the first one that has to do with actually thriving through an economic slowdown, which is being able to capitalize on distressed assets. An asset is something that you buy for the sole purpose of making money. A liability is something that you buy, which is something that loses you money. Your clothes are liabilities. Your vacations are liabilities. Eating out is a liability. All that stuff that makes you look rich are liabilities, but assets are things that you buy for the sole purposes of making money. This could be a real estate investment, not the home that you live in, but a real estate property that you're buying for the sole purposes of generating cash flow. This could be your stock market investments. This could be a business investment. This could be a startup that you're investing in. All these things are assets that you're buying or investing in for the purposes of making money. Well, when you go through a recession, you see 2 things happen. First, the bad assets become more apparent and they come out and they get hurt, and many times they will go bust. They will go bankrupt. They will go under. Something bad will happen to these bad assets. Second, the bad assets hurt the price of good assets, because now people get scared. They start panic selling. They get away. People sell out of fear, which causes the price of good assets to go down because not everybody's selling. This creates opportunity for you to come in and buy these good assets at a discounted price. These are called distressed assets. Distressed assets are companies, their businesses, their real estate, things that get hurt because of everything else around it, or these are assets that get hurt because the economy is hurting this asset, and you can come in and buy this asset, and if this asset can turn around, you have the opportunity to see huge returns on your money. Let me go over a few examples. When the 2000 dot-com bust happened, you saw the entire internet market get hurt because you had a number of bad companies, things like pets.com, things like boo.com, that went bust, that made the entire digital technology industry get hurt on the stock market. You had a lot of bad companies. Many of them went to zero. All their investors lost everything. But then you also had the good investments that got hurt very bad because of the bad investments that got hurt. These are companies like Amazon, companies like Microsoft, companies like Apple. When the 2000 bust happened, the Apple stock fell by over 70% in just 1 year. The Microsoft stock fell by 63% in 1 year, and Amazon fell by 92% in just 1 year. Let's fast forward to the 2008 crash. The stock market in general got cut in half. More than 50% of its value was gone in the 2008 crash, and real estate was decimated. The real estate market fell by upwards of 90% in some neighborhoods. I'm from Michigan, and our economy got hit especially hard when the real estate market got hit. And you saw some neighborhoods in my area where home prices fell by more than 92% over the course of the 2008 crash until 2012. Now let's fast forward to the 2020 crash. Stocks again were hit very hard. You saw the stock market fall by upwards of 40% in just a few weeks, and the more speculative assets, in this case cryptocurrency, fell by 50% in just 1 month. We have seen the same things play out in each and every market crash and economic downturn and recession for centuries now, where things go wrong, people panic, they sell, and this creates opportunity for new investors to come in and buy these distressed assets at a discounted price. Now, of course, in order to be able to purchase these distressed assets, you have to have access to cash, but the second thing is you have to have access to the right education. How do you find the right investment? Now, of course, looking back, if you saw Amazon stock fell by 95%, you might say that's a no-brainer, go in and buy it. But imagine that for a moment, where you see this no-name company that's fallen by 90%. Do you come in and buy, or do you run away? It can be very scary. And this is where you have to understand how involved do you want to be with your investments, because not everybody is meant to be listening to earnings calls. Not everybody is meant to be picking companies. Not everybody is meant to be investing in real estate. Not everybody should be buying cryptocurrency. Not everybody should be starting a company. Not everybody should be investing in startups. You have to figure out where it is that you want to be and how involved that you want to be. And once you figure that out, you want to start educating yourself on that topic. That way you can make better decisions with your money. Here's the reality. For 90% of people, you probably shouldn't be investing in individual companies. You probably shouldn't be going out and investing in real estate unless you are willing to put in the time and effort to do that. If you are willing, you are mentally capable of putting in the work and dealing with the psychology with it. Now, if you do want to invest in these companies, now you want to be going out and learning how to research companies. How do you listen to an earnings call? How do you read the cash flow statement? How do you read the balance sheet? How do you analyze the numbers? How do you figure out what's undervalued, what's overvalued? And then when you find that out, now you're looking for the right companies, and now you can make more risky decisions, because it is riskier for you to invest in a company on the way down than investing in a fund that gives you exposure to a lot of companies. So if you want to do that, fine, just understand you're taking on more risk. But if you're willing to do that, start investing in your own education to be able to do that. Now, for regular people who don't care about being investors, who don't want to be a full-time investor, who don't want to devote hours of their life researching how to invest their money, the next best thing is to figure out what it is that you want to invest in and how to get exposure to that with as little time investment as possible. For example, in the stock market, you don't have to go out and invest in companies. You can invest in ETFs or index funds that give you exposure to a lot of different companies in a niche. Now, what you can do is you can find a niche that you feel gets hit especially hard. Maybe it's tech, maybe it's healthcare, maybe whatever that you feel like will see a lot of upside in the future that everybody is doubting. Now, you can come in and invest in this niche when it's down, and then you can keep investing, and then if things go up, well, now you get to reap the rewards of that. Now, of course, you got to understand investing has risks. I'm not telling you what to invest in, but investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. If you have specific investment questions, talk to a licensed financial advisor. But the whole idea here is you find good assets that are hurt by bad assets, and then you want to be able to come in and buy these good assets at a discounted price. If you're not willing to invest in the individual assets, if you're not willing to put in the work to find what is that good asset, then invest in a broader base of assets in that niche, or you can even just invest in the broader stock market, invest in the S&P 500, invest in the general stock market. That's even broader. Again, the level of research that you do is going to depend on how involved you want to be. And if you want to just invest in the stock market, well, now you create a system where every week, every 2 weeks, every month, you are just investing your money into the market, and you let the market do its thing, because history has showed us that time in the market beats timing the market many times over. And if you don't want to put in that work, just create a system where now every week, Every 2 weeks, every month, your money is automatically invested into the market. And then the only thing you change is when things go wrong, when the market goes down, when the economy gets hit and the market hurts, that's when you come in and just buy more. You just increase how much money you're investing. That's the only thing you change. You don't sell, you don't turn it off when things go wrong. You want to keep buying because those are the times where you can buy even more shares of the companies for the same amount of dollars that you're putting in. Now, if you are an investor and you're looking for an easy way to stay up to date on what's happening in the markets, that way you can make better decisions with your money, then you can join Market Briefs. It's a completely free tool that I created. It's a completely free newsletter where every day my team is breaking down what's happening in things like the stock market, the real estate market, crypto, the global economy, and our own economy. That way you can make better decisions with your money. Not only is it free, but it's brief and you will understand what's happening in the markets, and you're actually going to look forward to reading Market Briefs every morning. I know this because we get emails every day from people talking about how much they love Market Briefs and how much value they get from Market Briefs for free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs for free down in the description below. The fourth thing that you can do, which is another way to thrive, is to start your own business. Now, this might sound counterintuitive because why would you want to start a business when the economy is down? Well, the reality is some of the biggest and best companies in the world right now were companies that were started during recessions, because when you have this type of recession, it's easier to find opportunity, it's easier to see where needs are, and as a little bonus, the cost of labor and many times the cost of materials also goes on discount when you have a recession. Uber, Airbnb, Microsoft, and Instagram. All four of these companies are very different from one another, but all four of these companies were started during a recession. The founder of these companies was not scared that the economy is down. The founder of these companies felt that there was a great opportunity that needed to be met, and they used it as an opportunity to start one of the largest companies in the world. The reason why you see so many good companies start during recessions is because it's harder to start a company during a recession, because if you have a company idea, it's going to be harder for you to go out and raise money. Banks are less likely to loan out money, and investors are less likely to invest money because everything is scary at that time. So now you have to be more creative. You have to be more efficient, and you have to be more productive to create a company that's worth getting money, and you have to be better as an entrepreneur to create a business that can create revenue. Because if you can build a business that can start making money during a recession, well, then that business can make a whole lot more money when the economy is booming. And so not only do you get to ride the wave of your company up, but then you get boosted with the economy growing as well, which creates a double win for the company. So if you have an opportunity, if you have an idea, and you are an entrepreneur, well, there's no better time to start a company than now. That's why you see so many companies that were created during boom times go bankrupt or go bust when things go wrong, because they have that too much money disease. They've always been around easy access to capital, easy access to cash. Banks are very willing to give them money. Investors are very willing to give them money, and they never had to experience a financial crunch. And then when the economy slows down and that money dries up, well, now they face the pinch. They don't know how to raise more money. They don't know how to be more productive. They don't know how to churn a profit. And then either they have to get acquired or they go bankrupt and they go bust. That's why it pays to understand how to be creative and efficient as an entrepreneur, and a recession forces you to do that because you have no other option. Plus, the added benefit that I was telling you is when you go through an economic downturn, well, it's much easier to find smart talent and get them at a discount because layoffs are happening everywhere. When you see the smart companies laying off the smartest employees, well, now this creates an opportunity for you to come in and snag some of these employees at a discounted price, because people are looking for jobs. When people are more desperate for jobs, you're able to get them at a discounted price. And if you're starting a business, you don't have all the money in the world to pay top dollar for everybody. But it creates an opportunity now for you to come in and get good employees at a discounted price. And then as the economy grows and as your company grows, then you can adjust their wages, you can adjust their salaries to meet market demand. And the fifth point to help you thrive through an economic recession is to stay calm, because the reality is it will pass. We have seen recessions happen for centuries now. We've seen booms and busts happen for centuries now. And what we've seen happen each and every time is things get bad and then they get better. Now, if you do get stressed, turn off the media. Listen, the media is in the business of selling hype, and their only concern is not your mental health, it's not your investment portfolio, it's getting clicks. And so if you want to tune out the noise, just turn off the financial media. Okay, market briefs, that's one of the reasons I create market briefs, is to get rid of all that sensationalism, is because it's one newsletter that explains everything going on in the markets without all that noise. So it's super simple to read. And if you open up the email, you see all the news. If you don't open the email, you don't see the news. So it's very simple in that sense. But you have to stay calm, because nobody makes a smart financial decision when they're stressed and when they're panicking. This is where you have to stay calm, remember to take a breath, and remember that things will get better. You're going to see a lot of people talking about how the world is ending, nothing will ever get better. That happens every time you go through a recession. But this is where you have to be a little bit smart, stay calm, and remember that things will pass, things will get better. And even if nobody's ever talking about that, even if everything looks like it's going wrong, just remember that sometimes things are never as bad as the media makes it seem, just like how things are never as good as the media makes it seem. So this is where you have to be able to draw your own conclusions, stay calm, and remember that things will pass. And if you ever get scared or confused, just look at a historical chart of the stock market or the real estate market. And what you'll see is, even if you bought at the worst time ever, over the last 100 years, if you bought at the worst time right before a crash, well, if you just held on, many times you ended up making even more money if you just held on for the long term. So this is where you have to understand what's a good investment and what's a bad investment. Don't make investment decisions out of fear. Don't make investment decisions when you're panicking. Have a calm mind and make investment decisions on a calm investment strategy basis. It's okay if you have to sell because things are going wrong, but don't do it because you're panicking and fearing. Do it because that's the right financial decision. If you want to go out and get a new mortgage, it's hurting you. If you want to go out and get a new loan to do anything, it's much more expensive to borrow that money. But what about the trillions of dollars of debt that's already out there? What about the billions and billions of dollars of corporate debt? What about the trillions of dollars of national debt? What about the trillions of dollars of household debt that people have?